Are you a beginner in the world of investing? Feeling overwhelmed by all the options and not sure where to start? Don't worry, because in this video, I'll share Dave Ramsey's best investment strategies that are perfect for beginners like you. As a beginner, it's essential to have a solid foundation and guidance from an expert. That's why we're going to explore Dave Ramsey's tried and true investment strategies that have helped him and, the countless individuals achieve financial freedom. Whether you're interested in buying index funds or mutual funds, we'll cover all the essentials so you can make informed decisions on your journey to wealth creation. By the end of this video, you'll have a clear understanding of how to get started on your investing journey with confidence and peace of mind. So let's jump right in. One of the foundational principles of Dave Ramsey's investment strategies for beginners is the tremendous power of eliminating debt, as he often emphasizes being indebted means being a slave to lenders, and that can significantly hinder your ability to build wealth and achieve financial freedom. When a substantial portion of your income is tied up in debt payments, you're left with fewer resources to invest and grow your wealth. Ramsey's approach advocates for breaking free from these financial shackles, allowing you to redirect your income towards meaningful investments that have the potential to yield substantial returns over time. To put this into perspective, let's consider the example of the average car payment in America. At a staggering $503 per month, that's over $6,000 per year that could be invested for your future instead. Imagine channeling that $6,000 annually into a well-mannered investment portfolio, such as a growth stock mutual fund over several decades. Once you've cleared the path by eliminating debt, the next crucial step in Dave Ramsey's investment strategies for beginners is embracing the world of investing. Ramsey's philosophy underscores that investing becomes the natural progression once you've freed up your income from debt payments. Now, with those funds at your disposal, and you have the remarkable opportunity to watch your money grow through strategic investments. A common misconception often dominates the financial landscape, the belief that investing is the only factor driving wealth creation. However, Ramsey challenges this notion. He points out that while investing is undeniably a vital aspect, it's just one part of the equation. He highlights how the financial industry tends to fixate solely on investing, ignoring the equally significant step of eliminating debt. This imbalance can lead to misleading advice and misguided priorities. Ramsey's approach, on the other hand, brings harmony to both aspects, recognizing that eliminating debts clears the way for meaningful investing, making your financial journey more effective and sustainable. In Ramsey's teachings, investing isn't merely about throwing money into the market and hoping for the best. It's about making informed choices, understanding the types of investment that align with your financial goals, and staying committed to a long-term strategy. By doing so, you harness the power of your income to create a solid foundation for your future. Dave Ramsey's investment strategy for beginners is centered around the concept of good growth stock mutual funds. He advocates for his approach as it offers a simple and effective way to participate in the stock market's potential for growth, while minimizing risks associated with individual stock picking. Good growth stock mutual funds typically invest in a diversified portfolio of stocks from companies with growth, and I should say strong growth potential. One crucial aspect of Dave Ramsey's investment approach is his preference for mutual funds with a solid 10-year track record. He believes in investing in funds that have demonstrated their ability to perform well consistently over the years. By choosing mutual funds with a proven history of success, Ramsey aims to increase the likelihood of achieving favorable returns and reduce the uncertainty that comes with investing. This focus on longevity and historical performance allows beginners to have greater confidence in their investment choices, knowing that they're based on the fund's established track record of weathering market fluctuations. Dave advocates a balanced and informed approach to investing, and that includes understanding the 4 types of mutual funds that he recommends. Each fund type has its distinct characteristics and associated risks, catering to different investor preferences and risk tolerance. Number 1, growth and income funds. These mutual funds, also known as large cap or blue chip funds, focus on well-established large companies that have a history of steady growth and pay dividends. They're designed to strike a balance between growth and income, making them a great option for conservative investors. The risk level for growth and income funds is considered moderate, and they offer stable returns over time. While they may not provide explosive growth, they offer reliability and can be excellent, and I should say, and emphasize on the excellent part because they are an excellent foundation for your investment journey. Number 2, growth funds. Moving on, growth funds are targeted at medium-sized companies with strong growth potential. Unlike growth and income funds, these funds prioritize capital appreciation over income generation. Growth funds are best suited for investors with a longer time horizon and a willingness to endure market fluctuations. They offer the potential for higher returns and are a valuable addition to a growth-oriented investment strategy. Number 3, aggressive growth funds. If you're looking for a possibility of substantial returns and are comfortable with higher risk, aggressive growth funds may be best for you. Also known as small cap or emerging market funds, they invest in smaller companies with the potential for rapid growth. The risk associated with aggressive growth funds is relatively high due to the volatility of smaller companies. However, for investors with a long-term perspective and a higher risk tolerance, these funds can be rewarding. Number 4, international funds. Lastly, international funds provide exposure to the companies outside of the United States, allowing you to diversify beyond domestic investments. These funds can invest in various regions and countries worldwide. The risk level for international funds varies depending on the specific regions they focus on. While they offer opportunities for global growth, investors should be aware of the additional risks associated with investing in foreign markets. One of the key takeaways from Dave Ramsey's best investment strategies for beginners is the importance of avoiding common investment mistakes. It's easy to get swayed by the allure of risky investments promising high returns, but as Dave emphasizes, chasing these quick wins can lead to disastrous outcomes. Instead of falling into the trap of chasing after the big next thing, it's essential to focus on a well-thought-out, long-term investment plan. Understanding your investments is paramount. Dave Ramsey underscores the need to thoroughly comprehend where your hard-earned money is going before committing funds. Investing in areas you don't understand can quickly turn into a recipe for financial disaster. Avoid the pitfall of putting your money into something simply because someone else says it's a good idea. Instead, take the time to educate yourself about different investment options, study the market trends, and seek advice from knowledgeable sources. By doing so, you're not only safeguarding your financial future, but also making well-informed choices that align with your goals. Dave Ramsey's approach to selecting mutual funds is grounded in a strategic and calculated process. When it comes to choosing the right mutual funds for beginners, he places significant emphasis on specific criteria that ensure a balanced and secure investment strategy. One of the key factors Dave considers is the track record of the mutual fund. He believes that a strong track record is indicative of a fund's performance over time, giving investors a clear picture of its reliability. This focus on track record helps to avoid impulsive decisions based on short-term trends. Stability is another crucial aspect that Dave looks for in mutual funds. Stability indicates that the fund's ability to weather market fluctuations and economic uncertainties. Dave's preference for stable funds aligns with his overall philosophy of creating a foundation for long-term financial success. He often compares his choice of mutual funds to his preference for stable neighborhoods with big oak trees when buying real estate, a testament to his belief in the power of consistent, steady growth over time. Dave also values the longevity of mutual funds. He leans towards funds with a long-standing history of performance. This preference reflects his confidence in funds that have navigated various market conditions and economic cycles. Choosing mutual funds that have stood the test of time adds an extra layer of reassurance, as it demonstrates a fund's ability to adapt and thrive over the years. In Dave Ramsey's best investment strategies for beginners, diversification and international investments play a crucial role in building a solid financial future. Diversification is the practice of spreading your investments across various asset classes, industries, and geographical regions. By doing so, you reduce the risk of your entire portfolio being affected by the performance of a single investment. Diversification helps you balance out the ups and downs of the market, ensuring that your overall investment remains more stable and resilient over time. It is a fundamental principle that promotes long-term financial success and safeguards your investments against potential market volatility. Another key aspect of Dave Ramsey's strategy is having exposure to international companies. Investing in international markets provides significant benefits, one of which is accessing a broader range of opportunities. Different countries and regions have their economic cycles and market dynamics, which means you can benefit from growth prospects in other parts of the world that may not be available domestically. International investments also enhance diversification by reducing your dependency on the performance of a single country's economy. By having a global perspective, beginners can seize opportunities in emerging markets and industries, contributing to overall portfolio growth and resilience. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.